This is Jessica Dunn, and today's discussion is about the corporate life cycle. There are three basic forms of business organization. We have sole proprietorships, partnerships, and corporations. Sole proprietorships are businesses that are operated by a single person for their profit. Partnerships are where a group of people work together in a business setting. So a partnership can be operated by two or more people. Often when we think of partnerships, we think of things like accounting firms, insurance companies, law firms, where there's a group of people. There may be one general partner, several limited partners within that organization. A corporation, however, can be made up of any number of people. It can be organized with a very small, closely knit corporation where there's only a few individuals involved, or it could be very broad. For instance, something like Walmart, where there are literally millions of shareholders that exist that own Walmart. Shares in a stock represent ownership. So those owners are called shareholders or stockholders. So let's go through some of the advantages and disadvantages of the different forms of business ownership. So sole proprietorship, just a reminder, that's a business that's operated by a single person for his or her own profit. Advantages include, first up, the big one is that the income earned is not subject to corporate taxes. So whenever you form a sole proprietorship, that income is taxed at your personal income tax rate because the business and you are inseparable. There is no distinction between business activities and personal activities. So any income earned by the business would be reported on your personal 1099, and you would pay personal income taxes on that. Along with that, goes hand in hand with the fact that you and the business are tied together, you are one, is the fact that sole proprietorships are very easily formed. It doesn't take a lot of time. It's very, very simple. Anyone could set up a sole proprietorship. A lot of people have a sole proprietorship and don't even actually realize it because you can operate a sole proprietorship without even having a federal employee identification number. You can just use your own personal social security number in replacement for that. But here in the Commonwealth of Kentucky, if you wanted to open a sole proprietorship, you could log on to the Kentucky Business One Stop portal, file for an EIN, get your withholding taxes, your sales tax forms, every part information that you need, and it would take you about an hour. It's very, very simple. You have to check with the department, with the Secretary of State to make sure that your business name is not a duplicate of someone else's, but it takes mere minutes to set up a sole proprietorship. Another advantage is that sole proprietorships are subject to very few government regulations. So there's not someone telling you exactly what you have to do on a day-to-day basis, as there sometimes is with corporations. So with corporations, they're very heavily regulated by the SEC. And here I'm talking about publicly traded corporations, which is the focus of this class. They do have lots of filings that they're required to submit. They do have strong oversight. But with a sole proprietorship, you have very few regulations. It's very secretive. You don't have to give out your personal information. You don't have to give out your family recipes that you use in your restaurant. It's your stuff. There are some disadvantages, however. The biggest disadvantage with a sole proprietorship is that it has unlimited liability. So this goes hand in hand with the idea that you and your business are one. So you get to be taxed your personal income tax rate, which is a good thing. It's very simple to set up, which is a good thing. But then because you are married to that business in essence. Anything that that business does affects you. So if you opened a restaurant under a sole proprietorship and you poisoned half of your county, you could be personally liable for that accident. So unlimited liability. If the business has a problem, you have a problem. Another disadvantage is that it has a limited life. So whenever you, as the business owner, die, your business dies. Now, of course, your heirs could take it over, but they couldn't do that without pausing and filing paperwork with the state and getting it approved. The difficulty in that sole proprietorship also comes whenever you're trying to grow. So whenever you want to grow your business, there's not a lot of ways to do that because number one, you can't offer investors any protection because the owners have unlimited liability. So if you can't give your investors protection, legal protection, so that if you make a mistake, the repercussions don't come to them, then you're not going to find many investors that are willing to invest with you. They would have to have a great deal of confidence in the business owner. Another side point of that is that if you wanted to take on debt, then there is only one person who can co-sign for that loan. There's only one person that we're looking at whenever we're looking at our financial ratios. Do you have enough cash to pay the debt as it becomes due? It's just you. We got to look at your personal debt to income ratio. We got to look and see how much debt you already have, your ability to repay that. So it's difficult to attract investors, and there's going to be a limited amount of debt that you can take on. A partnership, this is where a group of individuals work together to form a business. So 2 or more people. In every partnership, there is at least one general partner. That general partner does have unlimited liability, but those limited partners do have limited liability. And when I say limited liability, that means that they are only on hook for the money that they contributed to the company. So often you may watch law shows on TV and you see that the junior partner gets promoted and now they become a full partner. Their name goes on the sign. At that point, they have unlimited liability. They are on the hook for what happens with that company. Before that, there would be no loss to them other than the loss of income if the company were to fail. Advantages include a greater distribution of work. So there's more owners, there's more individuals to assist with the workload, and greater borrowing power. So if you were to go to a bank, there are more people to sign for that loan. So you have greater ability to obtain financing. Disadvantages, we already talked about unlimited liability. The other disadvantage is that it's difficult to transfer ownership. So if you think about 2 people that own a business together, what if one of them decides it's time to retire? What is the other partner going to do? Can they afford to buy out that original partner? If they can't, then who are they going to sell the other portion of their business to so that that original partner is able to retire? It's a very complicated process. You would have to first find someone that has the funds available to make that purchase. And second, you would have to find someone that you could actually work with. So someone whose personalities mesh. So it is difficult to transfer ownership when you have a partnership. And I've seen this in my real life, in my day-to-day life. My family owns a furniture store, and there were 3 brothers that owned it. One of those brothers sold out to the other 2 brothers. And then later on, the other brother decided that he was ready to retire, leaving only one remaining brother. In their instance, it all worked out fine. Everybody got along and they made it work. But you could see where problems would arise when someone's tired of doing it. They don't want to do this job anymore. They want to retire. They want to switch careers. They want to sell. Maybe you have a great offer on the table. Instead of it just being your decision to sell, now you've got to clear it with a bunch of other people. Corporations. Corporations can take many forms. In this class, we're mostly going to talk about C Corps. But there are other versions of corporations as well. The most common other version would be an S Corp. An S Corp is a corporation that allows you to be taxed as a sole proprietorship. But here we're going to focus on C Corps. A corporation is a group of people. A corporation is a separate legal entity created by law. So it is essentially an individual. A separate legal entity created by law is a corporation. Now that corporation, it can be a party to contracts, it can sue, it can be sued, it can own property, it can own patents. So corporations are separate legal entities. The owners of that corporation are referred to as shareholders. They own shares of stock. Each share of stock represents a fractional ownership in that company. So advantages are that it is very easy to grow. Because you have the ability to offer investors limited liability. So limited liability is a tremendous advantage for a corporation because it allows you to offer investors a portion of your company without them being on the hook financially for poor decisions. So that limited liability allows you to grow easily because now all of a sudden you have the ability to attract investors. So they don't have to be concerned with, is this person going to poison the entire world with poor food preparation? Now they know, well, we have protection. We have limited liability. So we can only lose as much as we invest. So it limits the downside risk. A corporation also has an unlimited life. So it's perpetual. You know, you think about a large corporation like Walmart. Walmart doesn't close its doors when a shareholder dies. There are probably shareholders dying every day who own Walmart. It has an unlimited life. Walmart doesn't pause business to recognize those deaths. Instead, those shares of stock move on to the beneficiaries. It's also easy to transfer. So if you have stock in a corporation, you can trade that stock in the secondary markets. So you can buy and sell it amongst investors with very little ease, and you wouldn't take a great loss. Now, there are corporations that are privately held. Privately held corporations, those are not listed on stock exchanges. With those, it would be a little less easy to transfer ownership because with that, it often requires approval of your shares to another person. So they would have to approve both the sale and the purchase and make sure that both people were good with the transaction. Disadvantages include corporate taxation. So with a corporation, the income earned, those earnings available for common shareholders, that net income is going to be taxed at the corporate income tax rate. Once that money is paid out to shareholders, that money is then taxed at your personal income tax rate. So there's double taxes. And we'll see that when we talk about financial statements. With corporations, there's also intense regulation. So if you are a publicly traded company, then you are going to be very heavily regulated by the Securities Exchange Commission, the SEC. They're going to have a heavy hand in what you have to tell your shareholders. So you would have to inform your shareholders of your compensation. So you would have to tell your shareholders how much your highest paid executives, how much they make, how long they've worked there, what their background is. So you're having to give up a lot of trade secrets. You're having to disclose your entire board members and what they do and what they've done and how much shares they own and how many board meetings they've gone to. There's a lot of information that you have to put out that you may not want your competitors to know about. Here's the reality. Most companies start as a sole proprietorship because it's simple, it's easy. They have some success. They contribute all the money that they have. They max out their credit cards. They take out a HELOC. They put all the money that they can afford to in that company to grow. They exhaust their personal resources. At that point, they reach out to their friends and family. They call their parents and say, Mom, I need a loan. Come, please be an investor in my company. We're growing so fast. I can't keep up with orders. I need some working capital. And Mom invests. Pretty soon, though, they tap out all those friends and family. They've all invested everything they can, everything they're willing to. Because first off, they may not have unlimited liability. They may if they've already converted to a corporation, but if they're still organized as a sole proprietorship, there is no protection there. But once they've realized some success, they then change their organization to corporation. So they switch from being a sole proprietorship to a corporation. Now, opening a corporation is not nearly as simple as opening a sole proprietorship. You have to jump through a lot more hoops. And most often, individuals hire either a CPA or a lawyer to help them with that process. But those very successful sole proprietors, they convert their organization status to corporation. So then that allows them to offer liability to their existing shareholders. It allows them to access more external funding. So now if they're very good, they could even reach out to a venture capitalist. And a venture capitalist may very well give them money in exchange for stock because of that limited liability. So here in the U.S., we see that 17.6 million sole proprietors exist, while only 4.8 million corporations exist. So there are substantially more sole proprietors than there are corporations. 73% of all firms are organized as sole proprietorship, 20% as a corporation. When we look at the amount of money they bring in, however, we see that sole proprietorships only account for 5% of all receipts. Corporations represent 89%. So corporations, there are fewer of them, but they make much more money. And that's because once a company becomes successful, they are forced to convert to a corporation to obtain additional financing in the form of equity. Now, partnerships are a different story. 7% of all firms are partnerships, while they bring in 6% of receipts. Now, partnerships are, usually they're going to be constricted to real estate firms, insurance companies, law offices. So there's a very small segment is actually being organized as a partnership. And for the percentage of firms organized as a partnership, they do bring in a lot of revenue. So this is how it may feel, the corporate structure, the corporate hierarchy. So when a corporation, how it's formed, it's a hierarchy. This is how it may feel, but here's the reality. At the top, we have the owners of the company. The owners are called shareholders or stockholders. They elect the board members. So shareholders, there are different types of shareholders. There are institutional shareholders, there are individual shareholders, and there are block holders. Institutional shareholders are shareholders who own stock on behalf of someone else. So an example would be a pension fund. A pension fund may own shares of stock, but they own that stock for the employees of that company that are going to receive that pension. Individual shareholders, they're just people like you and I. We have a few shares here, a few shares there, nothing remarkable. Block holders are wealthy individuals. They own 5% or more in a company. That's called a block holder. Now, there are different types of shareholders, but there's also different types of stock. We can have common stock or preferred stock. And within common stock, we may have different classes of stock. So we could have Class A common stock, Class B common stock, Class C common stock, and we could have preferred common stock. Each of those different groups of shareholders are going to have different voting rights. So usually what happens is a company will be formed, and those pre-corporation investors, so that individual who started the company and their friends and family that originally invested, they would declare that all of the stock that those individuals owned are called Class A shares. And they may say that those Class A shares get 100 votes per share of stock. The purpose of that is to allow those founding investors to retain control over the company while allowing the company to grow and take on additional investors that have lower voting rights. So it allows those founding members to maintain control over the company. So Class B shares, they may have 10 votes per share. So maybe before the company went completely public, maybe they found an investor, a venture capitalist, who is willing to invest a large sum of money, and this is before they've gone public. So they're organized as a corporation, they're just not a publicly traded corporation. So those Class A shares were the founding family that started this company. They then take on a venture capitalist. So they declare that venture capitalist money is Class B shares, and they're going to get 10 votes per share. That goes really well. And they have reached all the milestones, and now they're ready to become a publicly traded company. When they issue that stock and they sell it in the primary market and it's being traded on the secondary market, so it's on the stock exchanges, that stock would be Class C shares, and they would get 1 vote per share. Now, this is completely made up. I made up the whole thing. This is not the way every company is organized. In fact, most companies only have one class of common stock, and that one class gets 1 vote per share. But they can take on any form imaginable. Preferred shareholders usually only have one board member that they get to elect. They don't get to vote for all the board members. And we'll get into the differences between common stockholders and preferred shareholders again later. But those shareholders, they elect the board members. Those board members can be classified or not classified. Classified boards have a term of 3 years. So every board member is elected for a 3-year term. So 1/3 of the board comes up for election each year. Non-classified boards means that board members have a 1-year term, and so the entire board is elected on every year. The reason why a company might be classified is so that they can protect themselves against a hostile takeover. So if someone were to come in, buy majority shares, have voting rights, they couldn't replace the entire board in 1 year. It would take a period of time for them to take complete control of the company. Those board members, they hire the CEO. They're responsible for CEO compensation and hiring and firing. The interesting thing is that the board sets the CEO's pay, but the CEO sets the board's pay. So you often see that they get raises in lockstep with one another. The CEO hires the top executive team, and the executive team hires the managers, the employees. It's just a hierarchy.